Back in 2017, Tencent became the first Asian technology company to cross $500 billion valuation mark. By 2020, the company had crossed Facebook's valuation. But Tencent's rise was not sudden. Tencent hit gold with social media in the desktop era. It became ingrained in people's lives with instant messaging and mobile payment app WeChat in the mobile age. Although the gaming business generated the bulk of the company's revenues, Tencent's strategy to open up its ecosystem and invest in startups paid off immensely. The company took stakes in ride hailing service Didi and food delivery platform Meituan. The company's deep pockets and vast network of users also made it a powerful global investor. It enabled Tencent to take stakes in Spotify, Tesla, and Snapchat. The reason I'm referring to Tencent is that the company stands out as the poster boy of China's homegrown technology revolution. Tencent managed to make the most of China's growing tech savvy, affluent middle class. The company's diversified presence across China's tech platforms and coverage across the bulk of its population made it a stock market favorite. When Beijing began a crackdown on Chinese technology companies in late 2020, the stock of Tencent crashed 50% from its early 2021 peak. However, the company was amongst the ones to recover well. In 2024, Tencent's shares rallied by over 30%, with the company adding $90 billion to its market capitalization. This cemented its position as the second largest public company in East Asia after chipmaker TSMC. Now, how does Zomato compare with this? As India's leading online food delivery platform in terms of value of food sold, Zomato's offerings include food delivery, dining out services, loyalty programs, etc. Quick commerce subsidiary Blinkit currently contributes less than 30% of revenues. However, investors are betting on the profitability and hyper growth of this segment. Now comes the interesting part. Like Tencent was for China, Zomato's IPO marked the beginning of startup tech IPOs in India. Although one of India's first technology startups to get listed in India, investors got skeptical of the company's financials post listing. But quick commerce subsidiary Blinkit turning profitable changed that. Investors are now so optimistic about Zomato's future prospects and ability to build a wide network through multiple platforms that the company is enjoying valuations that even seasoned manufacturing enterprises cannot aspire for. On the way to the Sensex, Zomato has already trumped the market cap of Tata Motors. So, does Zomato's inclusion in the Sensex make the case for technology startups in India finding themselves in stock market glory? Just the way Chinese technology majors like Alibaba, Tencent, JD.com were stock market favorites not just in China but globally a few years back. There is no doubt that India needs to become self reliant when it comes to critical technology, else, corporate India may continue to face bottlenecks. Consider this for instance. On July 19, 2024, an outage at Microsoft left airline companies, banks, hospitals, and several corporates across the entire globe struggling. The blue screen of death error had caused millions of devices to shut down. Turned out that a cybersecurity company called CrowdStrike, which produces antivirus software, issued a software update that went horribly wrong, leading to the so called blue screen of death on PCs. Microsoft later admitted that the preliminary root cause was a configuration change in a portion of its Azure backed workloads. Azure is Microsoft's public cloud computing platform. So, excessive reliance on global technology giants could become a double edged sword over time. Meanwhile, most companies in India have multiplied their tech spending. The spend on technology is not restricted to platform companies anymore. Companies across the board are spending on AI to integrate the technology in their day to day operations. For instance, take the case of manufacturing majors like Maruti Suzuki, Apollo Tyres, Godrej and Boyce, Saint Gobain. AI has not only helped these companies reduce costs but also increase efficiencies and reduce workplace accidents. For instance, Apollo Tyres has achieved 8 to 10% efficiency gains by using data along with AI or ML in the tire compound mixing process. The tire maker is now working on improving its sales forecasting by using AI to check weather conditions, exchange rates, etc. This allows it to provide much better availability of stocks at lower working capital. Godrej and Boyce is currently working on implementing AI powered digital twins for customer, product, process, and employee. The digital twins will help in making simulation to operate and gain efficiencies and reduce margin of error and costs. Saint Gobain intends to use machines that come with pre-installed AI edge devices. An edge device is an endpoint on the network which is an interface between the data center and the real world. Therefore, the success of technology startups like Zomato in India is necessary for the growth of the tech ecosystem. Also, there are bound to be more tech regulations. For instance, in China, the new rules forbid concealing negative online reviews or algorithmically collecting competitors' data relating to sales made to consumers. So, the tech ecosystem in India is yet to evolve, but the steep valuations of the tech startups are primarily to cash in on the market euphoria and for giving their early investors, which is venture capital firms, family offices, etc., a very profitable exit. Therefore, understanding the ecosystem of the business model is absolutely critical to evaluate a tech stock. To conclude, Zomato's inclusion in the prestigious benchmark index of 30 stocks could certainly be India's Tencent moment. This does mark the recognition of the long term potential of India's homegrown technology entities. However, taking a realistic view of the financials is necessary before buying into the valuation story. Hope you like this video. Thanks for watching.